Welcome to the Global Dialogue with Jeff Tennis on Investonomics, an initiative by ICICI Securities. Thank you, Jeff, for joining us today on the show. Jeff, let's start by talking about 2021. It's been a sort of significant year in many ways. Should have been a good year for emerging market equities. Why have they not done as well or outperformed developed market economies?
You would have expected emerging markets to do better this year because you've had a global recovery and a pretty strong one, at least so far. And I think two things have made it more difficult for emerging markets to do well this year. One is that the dollar has been a lot stronger than people had anticipated. I've always argued for many, many years that a strong dollar is negative for emerging markets and a weaker dollar is good, because when you get a weaker dollar, money chases risk, chases yield, goes towards markets such as EM. And I think the dollar surprised everybody this year by being as strong as it's been. So that's been a key factor. But the other thing is more at the micro level, and that is that China began the year at over 40% of the MSCI EM index, and China, of course, had a very poor year. Now, EM is up about 3% this year. China's down about 5%. The difference is not huge. But in a year when I think people thought China would do well, is also, as indeed I did, it's been disappointing. And that's for a couple of reasons. Number one, they've been cautious about allowing debt levels to rise too much in China, and so they've been, clamping down on credit growth to a certain extent. But also, more recently, as everybody knows, they've been targeting the tech sector, both within China and in terms of listings in the US as well. So I put it down to those two factors, the dollar and China, which means that if you're looking at markets that have done well this year, Taiwan has done well, Brazil latterly has done well, they just haven't been big enough to move the index enough to get it to an outperform position, which therefore I think represents a very disappointing year.
Well, I'm going to add India to the list of outperformers in the emerging market.
Yes.
Okay. But let's talk about the US growth and inflation and what's the outlook there, because any sort of adjustment on the Fed policy will have a huge impact on global liquidity and then in turn impact the way equity markets have been doing. What are you making of it? We saw those Fed minutes and that disturbed the market briefly.
Well, I think the market's getting something wrong here. And of course, it's very bold of anyone to say the markets are wrong. I think the markets are wrong because they are believing right now what the Fed is saying, that this pickup in inflation will be transitory. I'm much more concerned that although inflation is not going to go to very high levels, it's probably going to stay 5, 6, who knows, maybe 7% for a period of time. But you're also going to get a wage pickup as well, I believe. In fact, you're seeing it already. You're getting a little bit of a wage price spiral, which means to me that the market in getting reassurance from the Fed that they're not about to taper their bond purchase, their QE, I think is getting it wrong, because the Fed is going to taper QE, and they'll probably have to taper more earlier than I think the market is currently discounting. And once it becomes clear that this inflation is a little bit more persistent than anticipated, that is going to create some waves, I think, for markets, because the Fed will have no choice, I think, but to move on QE and ultimately on interest rates a little bit earlier than anticipated. Now, let me just say this, if I could, Samina, because I don't want to get carried away here. I don't think there's a big sell-off coming. I really don't, because the economy is strong, earnings are strong in the US, but I think we're misinterpreting what the prospects are for Fed moves because of the inflation story. And that means to me that bond yields are going to go higher from here once again, and that is going to put equities under a bit of pressure for a period of time. Let me just say one other thing. Obviously, one of the reasons yields are falling at the moment, or have been falling, and the market has done well, is because of this Delta 4 variant on the coronavirus. Now, I'm not going to opine on that as such, but I do genuinely believe that this will not stall the US recovery. It may slow it down. Next year will be slower than this year anyway, but it's not going to take us all back into lockdown and into recession. And therefore, I don't think at the end of the day, it's going to make a lot of difference about the Fed's timing on tightening policy, which I think is a bit closer than the markets are currently believing.
I take your point, Jeff. We might not have a big sell-off coming in, but there would be some tapering, I'd imagine, on the recent gains that markets have picked up. I mean, we are talking $3 trillion here, which flooded the global equity markets. Do you think in that case, if a sell-off is not coming, a topping out or taking some profits off the table is what's advisable?
I think that's right. I mean, I wouldn't be aggressive in terms of profit taking, but the market has just been going up steadily. Even now, after a pretty big sell-off on Friday and Monday, the market is pushing up against new highs. I think all I'm really expecting that to happen is to be a stalling of the market for a period of time, some sort of a modest pullback, maybe 5%, 6%, 7%, but nothing too dramatic. But I do think the market's got a little ahead of itself now because of the concern over coronavirus, the new variants, but also because of the risk on the inflation front, and therefore the risk in terms of Fed policy. But do I think there's a big bear market coming? Absolutely not.
Right, that sounds promising. Jeff, we'll talk about the global economy recovery now. Do you feel like it's already past its peak recovery growth, which was what we were expecting in 2021? Or do you think a strong recovery, strong recovery on the economy can be anticipated going into 2022 as well?
I think importantly, the economic growth will slow down in 2022. 2021 will prove to be the peak growth rate. That is no surprise. I mean, we now know from the National Bureau of Economic Research that they have confirmed that we have the shortest but sharpest recession in the US economy as the coronavirus hit. As you come out of that sort of recession, you typically get a very strong year. And from then on, it flattens off a little bit. But the fact that it might flatten off a little bit does not mean the market has to go down. It just probably means the gains going forward will not be as strong as they've been in the last 12, 15 months or so. And that will not be a surprise at all. It's also worth pointing out that because of the ongoing monetary accommodation, and one thing that is very different from last cycle recovery after the global financial crisis, massive fiscal expansion in the US, and there's more to come, of course. We don't know how much more, but there's more to come. Even in 2022, the growth rate of the global economy, the growth of the US economy, the global economy generally, will be higher probably than any one single year of that previous economic recovery. So we're going to have a better trajectory, I think, of growth in this cycle than we had in the last cycle.
Jeff, let's talk about the outlook for oil prices and commodities in general. Do you think the commodity super cycle is here to stay?
I do, within reason again. I mean, we certainly went to extraordinary high levels, and you've got to look at different commodities at different levels. Obviously, some of the commodities like lumber, iron ore, to a certain extent steel, went to very, very high levels. Oil, of course, even today is sitting 50% down from its peak, for example, in 2005, 2006. So, you've got to look at it from a commodity by commodity basis. But I believe long term, the global economy is opening up again now. It is going to have a prolonged economic recovery, by the way, which I do not believe modest, gentle Fed tightening a little sooner than the market thinks will not particularly damage. I think that's going to give you continuing strength of commodity prices. China is going to grow as well. which is obviously going to be supportive of growth, and a lot of other countries. India is going to grow. Latin America is going to recover. Europe is having a better year. And I do think going forward, although my view is that if the Fed does end up tapering, withdrawing some of this accommodation, maybe even raising interest rates a little bit sooner than the market anticipates, could support the dollar again for a period of time, which of course will be challenging for the emerging markets. At the end of the day, the dollar is overpriced, and I think the dollar will ultimately come down, and possibly come down sharply, maybe 125, maybe 130 against the euro. That's going to be really good in the long term for EM, and that's also going to be very, very good for commodity prices. On oil specifically, as ever, as you know well, and the listeners know well, it's going to be so much driven by politics, so much driven by supply issues. I think long term, you've got to assume that Iran is going to come back online. Libya is probably going to come back online. I think the fracking industry in the US is much better at controlling output. However, and at the end of the day, how well will OPEC Plus hold together in the face of rising demand? So I tend to think oil prices are going to edge higher over time. And I think probably in a year or two, we'll get somewhere near $100 for Brent, but I don't think we're going to go back to the crazy highs of, the mid 2000s when we got to $150.
I guess $100 is comforting if you look at how
yes, indeed.
Going in the Middle East, right? But let's move away from commodities and talk about India. So while emerging markets as a bloc hasn't done too well, India has seen the highest FI flows amongst its peers. Do you feel like the structural outlook in India has improved significantly, and hence we could continue to be beneficiaries of foreign investors?
I'm not sure the structural outlook is particularly improved. Again, I think investors are probably looking down the road to further improvements from obviously the tragic situation with respect to coronavirus, further improvements therefore in the economy, looking ahead to that as being supportive. But I also think that the problems that China is having this year is being, first into the coronavirus, first out, first major central bank to start tightening policy, and indeed now they may be even starting to loosen it again. So we've gone all over the place with the PBOC, but it's created a slightly more, should we say, risky is too strong a word, slightly duller outlook, I think, for Chinese growth, and maybe that's pulled some money towards India, And yet, at the end of the day, I also feel, and I've felt this for a long time, that despite the many changes at the helm of the RBI in recent years, monetary policy has been pretty good in India. Monetary policy has been quite supportive. And although, as ever with India, there are big question marks about further structural reforms, it always seems to be slower than people think it's going to be. And also some worries about the budget deficit situation. I think if you roll all that into one, with India not facing the sort of structural imbalances and inflation risk, I think that have worried people about Brazil and worried people about Turkey and South Africa. And you obviously have, as I say, China not doing as well as anticipated. These are all the sorts of reasons why India, I think, is attracting money, to a significant extent in 2021.
Also, I want to just draw and talk about India in relation to China. I mean, up until now, it's always been an either or when it's been about India versus China. Recently, of course, the sentiment towards China has changed dramatically. Are you anticipating that a China plus one strategy could actually start playing out, which over the medium term would be a huge positive for India, I'd imagine?
Yeah, I mean, let's leave the link to India aside for a moment. I think what's happening in China is quite damaging for China's position within the emerging markets. I mean, what's happening here? And I don't mean the Chinese authorities wanting to rein in credit growth and wanting to prevent there being a debt problem down the road. I mean, obviously, they've got a gigantic debt problem anyway. Debt to GDP is around 300%. They don't want that to run out of control. But I think the way that China is trying to control to a much greater extent than people thought would be the case 9 months ago, the tech sector in China, at the same time as they're in, frankly, a fight with the US and the US authorities about under what conditions these tech companies and indeed other companies can list in New York. All of that is taking the sheen off China when, unfortunately, perhaps, China is now such a gigantic market within the emerging markets universe. I love to make the point to people that China joined the EM index in 1996, when it was therefore came from zero. By 2000, it was about 1 to 2% of the index. Well, today it's 38%, and a few months ago, it was 40 to 42%. So, as China's opened up and you've increased the number, you've allowed the A shares, the locally listed shares, into the MSCI index, dramatically increasing China's weight over the last 5 or 6 years or so. Suddenly now you're confronted with an index which is very top heavy with China, and the Chinese authorities are not helping foreign investors just when foreign investors allegedly have got to put more money to work in China. So let me just say one other thing. That's leading, of course, as you will be well aware, to all this debate about, do investors want to focus on an emerging markets index ex-China? Because China's become so big and it's so hard to read what's going on. All of that together, I think, really does benefit a lot of the other sizable markets within EM. Taiwan has had a great year, which has got a lot to do with microchips and TSMC, of course. Korea, not quite such a good year. India's had a good year. So I think India will attract money, has attracted money that is perhaps previously thought to have likely to go to China. In fact, I still have the view that people prefer to invest in India than China. You know, people find China a little opaque, and I'm not being rude here. This is just what people think. And I think a situation now where China's not done so well this year, and there are real issues which concern investors, this is a good time for money to go into India, and we just have to hope that the Indian market will perform to basically justify those choices.
Completely agree. Jeff, the big talking point back here is internet companies and those listings. Zomato now, and then Policy Bazaar and Paytm in the next 60 days. Are you excited about owning Indian internet companies?
I like the tech sector a lot generally. One thing we have not addressed is the fact that I still, notwithstanding the fact that I think we're in the early stages of a global economic recovery, I tend to believe, particularly in the short term with the concerns about monetary policy in the US, etc., I still think a growth strategy is preferable to a value/risk/ cyclical dominated strategy. And therefore, I really like tech a lot. Now, tech in China has been disappointing for all the reasons that we sort of alluded to here. And so I think with Indian tech companies coming to the market, step by step, if you like, I think as long as they're sensibly priced, I think they will tend to go pretty well. Because if you think about it, the performance of Chinese technology in the last 12 months compared to the performance of US technology has just been terrible. You look at the NASDAQ versus some of the stocks in China, and that's not because there's anything inherently better about these US tech names, although of course they're global names compared to the Chinese names. It's because of the government pressure on the tech sector in China. So if you are going to see these tech companies coming to market sensibly priced, let me reiterate that, I think there's going to be a huge amount of foreign interest in those. Now, the big question as ever with tech generally, with IPOs generally, with India always, is are the valuations going to justify the level of interest? So I think valuations are the issue here, and are those IPOs going to be priced sensibly? But I fully expect there to be a lot of interest, and I think tech is going to continue to be a growing sector in the world economy. It's going to be a secular growth story. the sector is going to become bigger and bigger in the EM index and indeed in the global index. And so if India is going to start contributing to that in new and additional ways, I think that's very good news for India.
Right. Jeff, I'm just going to break the Indian market down into two blocks. On one hand, you have tech and pharma. And on the other hand, you've got industrials, metals, SBI, banks, domestic cyclicals, really. Now, in the last decade, FIs have really shied away from domestic cyclicals. Currently, of course, there's some interest coming back into the space, at least locally, right? They seem to be coming out of a down cycle after months and years of underperformance. Has the view changed now?
I'm not sure. I mean, obviously, the view has changed in the sense that a lot of people globally, a lot of investors globally, have played the value trade, have played the risk trade, the cyclical trade in emerging markets in recent months, and indeed have done relatively well. I actually think if you look at the cyclical story in EM, India is not the first and obvious place you would go to. You would go to Brazil. You would go to Russia. Obviously, the politics in South Africa is very messy at the moment, and that's not an obvious place to put money. You would go to certain cyclical stocks in Korea. I don't think India is necessarily going to be viewed or is viewed now as one of your first ports of call, if you like, if you want to make a cyclical play. Now, of course, local investors may very well be interested in cyclical plays in India and within the local market. And I'm not saying the foreigners will not be interested at all. I'm just saying that I think foreign interest in India is probably going to be more focused on, as I said, the growth names, and you mentioned two sectors there, technology, pharma. Pharma, of course, is always of interest to foreign investors. Now, one sector, and it's never quite clear which bucket to put it in, but I do think, notwithstanding the challenges that Indian banks face in terms of their asset quality and concerns about that, which are always in play in India, in a world where I think going forward, the yield curve in a lot of countries is going to steepen. Now, of course, in India, it's already steepened somewhat, much more so than in the US. But in a world where you're gradually going to get higher interest rates and higher bond yields, anticipating higher interest rates, in my opinion, I think the banks will do relatively well. So the banks, in terms of a lower price, lower valued, perhaps risky, perhaps sort of cyclical sector, is an area I think that will attract foreigners. Foreigners like Indian banks, or like the high quality Indian banks anyway. But some of the cyclical sectors, I'm not sure they're going to be at the front of the queue, frankly.
Right. Very lastly, Jeff, we're short of time, but I'm just going to try and get two questions in together. Firstly, do you think the broader vaccination campaign across emerging markets could help them perform or outperform developed markets in the next 12 months? And if yes, what are some of your favorite emerging market equities for the next 1 year?
The answer to your first question is, of course, yes. That would help enormously emerging markets to outperform. Now, whether you will get that vaccination happening. I mean, there's a shocking statistic I saw today that something like 8 to 10% only of global populations is fully vaccinated against this virus. So there's a long, long way to go. But if we could get the vaccines broadly available, of course, within what we're talking about here, the classic emerging markets, but also in other less developed economies, particularly across Africa, gigantic boost to the global economy. Will it help EM to outperform? I think before you get there, you've got to get through this period of Fed beginning to remove accommodation. My view, and I'm sorry to digress again, my view is that we all know this tapering is coming. Unlike 2013 when we were surprised, we all know eventually rate rises are coming. I think I'd just like to get on with it, because once you start to get on with it, the markets will say that's great, the inflation thing's under control, the Fed's is on the game, it's controlling everything. Now, if once we get through that initial concern about monetary policy tightening, I think the dollar goes down again, and that's when I think emerging markets will do better. And if I was, heading in, let's say 12 months, heading into 2022, I would be overweight China. I would be overweight still Taiwan because of particularly the chip sector. I would have selective monies in some of these higher risk markets. Brazil, I would favor. Russia, I would favor. And I would have a good weight in India. Whether I'd be overweight, I'm not sure, but I would have a decent weight in India as well. So those would be some of my favorites. Worth pointing out, by the way, Samina, that the best performing emerging markets this year have been in the Middle East. Oh. Saudi's done well, UAE's done well, and I think money's going to find its way there, especially if people think that oil prices are going to continue to rise.
Absolutely, Jeff. It was lovely talking to you this evening. Thanks a ton for joining us on the show.
Thank you very much.